What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house. It's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Bernie Johnson. How you doing today, Bernie?
Outstanding. It's a
Excellent. Sorry, keep going.
it's a great day. I enjoy being on your show for the first time.
Exactly. Excellent, excellent. And I got some great news for you, Bernie. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite member of the audience here? It's because this is a chance encounter where I interview real estate people. That means deal sponsors. That means buyers, sellers, investors, all kinds of things like that. And you may ask yourself, well, why on earth do you want to do that? Well, part of the reason is because the SEC requires that you have documented substantive relations if you're going to be doing a 506B deal. So it's a good idea to get that documentation of, what's the person up to in these deals and all that kind of stuff. Bernie, I've got your bio right here. It says that you're a 36-year veteran as a portfolio manager and investment advisor, and you owned a financial services company and consulting practice. You're retired. You're already an RIA and an RIP, as well as an RFC, a registered financial consultant. I haven't seen that one, and a financial paraplanner. Do you want to say a thing or two about any of those qualifications before we continue?
Well, all those qualifications I've held when I was in the investment management business.
Mhm.
And since I've retired, I just still hold the designation with the paraplanner through College of Financial Planning. That doesn't go away.
Okay, well, there you go. And so in these days, you're a real estate advisor based on your experience of currently owning 125 multifamily units of multifamily property. And of course, one of the things that I have to emphasize, full disclosure to people in the audience, when you talk about door count in multifamily and things like that, it's pretty frequent for people to kind of inflate their sway or that sort of thing, as far as maybe they own like 2.5% or 5% of the GP share. But you go for a different approach. Do you want to say a thing or two about that, Bernie?
Well, the approach that I've taken is to just own all of the units myself. I have one deal where I have one of my best friends is in with that one particular property. But other than that, I own 100% of the properties myself.
Excellent, excellent. And you used to be the host of the Bernie Johnson Smart Money radio program. That sounds pretty wild. How was that experience?
Well, I did that for about 10 years when I was in my practice, and it covered about the central all the way through the southern Illinois territory for the listening audience.
Excellent, excellent. So let's go through the first segment that I always have in these chance encounters. It's the 5 distinct motivations. Before that, I got to say, but wait, check your 8. Now, Bernie, I know that you're not the biggest fan of technology and all that kind of stuff, but I would like you to try something for me. If you could try and look through the camera and down there into the user's device, you might see this big, ugly subscribe button, and maybe they haven't done anything with that. So maybe they should, okay, no, it's just a stupid joke. Anyway, I've been doing it in every episode, so it's just a habit at this point. But quickly, let's go through the 5 distinct motivations just so that people in the audience know what really drives a lot of commercial real estate investors, syndicators, buyers, sellers, and deal sponsors, and all that kind of stuff. The first one of which is preservation of purchasing power. Some people are doing their deals because they're either retired or work optional, and what they're really looking for is to find some sort of asset where they're not really going to have that overall wealth or purchasing power of the cash flow deteriorated by inflation. Or the other thing is that they are going to be buying only when there's an asset crash or there's a particularly steep discount. Of course, you should always try and get the steepest discount that you possibly can. But I label all that under preservation of purchasing power, and full disclosure, that's not where I am right now. In my real estate career right now, I am focusing on trading time for wealth, and that's because I've got a background in technology. Specifically, it's the CRM online funnel industry, and I owned an agency for that since 2011. And when I got into doing that for real estate full time, then I found out that I was on the wrong side of the right business, because if you are just seeking a ever increasing salary, you're going to be paying mountains and mountains of tax, more tax than anybody else. So it hit me that I need to pivot and find a way to do these deals for myself, partnering with deal sponsors and being paid back in the form of deployed capital, aka equity, rather than higher salaries. So that's what I'm up to. Now, of course, some people are more concerned about taking back their schedule. They want to fast track their retirement, or at least, work fewer months per year, fewer weeks per month, or something like that. And that's a big motivation for a lot of people, but it's definitely not for everybody. Some people are more powered by ambition. They want to buy their entire hometown. They want their names on some giant building and the biggest yacht in the pier, that sort of thing. And even though that's vilified in some circles, I need to emphasize the fact is you need motivated people who will actually make a difference and make sure that people have a safe and nice place to live. So you need to have people who have that drive, that fire to stick with the business, and I think that's really important. And then the fifth motivation is helping people who need it. Some people, rather than making sure that their great-grandchildren never have to hold a day job, they've picked a sector of society or the environment or animals or something like that. And when you want to make a big splash or a big impact on the world, then there's a financial component that has to be addressed. And so that's why some people are making their acquisitions. So Bernie, of those 5 different motivations, what combination of them stood out to you? I know you're already retired in a lot of ways, so that's got to be one of them, but go ahead.
Well, I just think that people need to make decisions on the reason why they first, in a bigger perspective, why they want to accumulate wealth. And there are certain areas and certain assets that people are better in, and real estate is one of the tools. I'm not just a 100% real estate person. I think there are multiple ways, dividend stocks, business to me is the biggest area that you can become wealthy. But for the average person, and I don't mean that in a light of, belittling anyone, but the average person needs to have some, in my opinion, real estate in their portfolio. Now, having said that, they have to have the right perspective and the right motivations. If they don't have a lot of patience and don't have a long-term perspective, a longer-term perspective, meaning 10 years, this real estate is probably not for them. And even when I consulted with my clients in wealth management, I always encourage people to also have some money into real estate. So it's not for everyone, but there are so many different approaches to it. I believe that the safest play is multifamily property. I'm not big into individual homes. I think that is a higher risk venture, but multifamily is the way to go. Mm-hmm. And so that perspective really sets the groundwork for everything that for wealth accumulation.
Mm-hmm. I love it. I love it. And of course, my next segment here, it's about tolerance for risk assessment. It's actually inspired by the fact that if you've ever been involved in an off-market deal, these are the 506B deals that you're not allowed to publicly discuss, then you have to fill out this questionnaire, at least the securities attorney who really should have been involved in the deal. They will have insisted that everybody fills out this suitability questionnaire with all sorts of invasive financial information, like what's your net worth and all that kind of stuff. Not all that much fun to answer. But as I was going through one of those qualification forms, I found that the question about tolerance for risk, I found it lacked utility. I thought that it doesn't matter which of the multiple choice answers you choose. It didn't really give me anything I could take to the bank, so to speak, and really rely that I know the level of sophistication of an investor. So I made my own one specifically for this show, and it's a fill in the blanks question. It is, there are many popular investment asset classes, but I think blank is too risky. So Bernie, with your acumen, there must be something out there where you wouldn't touch it with a 10-foot pole. What's too risky for you to invest in?
Well, I like risk, and most people run from risk. But if I was to answer that, I would say commodity options. That is something that you have to watch by the second because the market can go against you in minutes and seconds sometimes. So unless you're extremely sophisticated, experienced investor, I would stay away from that.
I love that answer. I love that answer. So that brings me to the next question, which is favorite deal metrics. And I have 14 on these on this next slide. And of course, it's not a comprehensive list. And I get that some people, they're more front of house. Of course, Bernie, you own your own properties, so you're going to be better acquainted with each of these. But for anybody in the audience who's only listening and not watching, I'm going to list them off so that you can enjoy this just like the video audience here. So the first one I have here is cash on cash. Then I have IRR, which stands for internal rate of return, basically talking about equity multiples. Then you got cost per door, net operating income, going in cap rate, which is really talking about the difference between the cap rate that you're buying at versus the comparable properties in the neighborhood, because that's a really obvious indicator of the discount you're getting. Then there's the loan interest rate, especially if you're going to be assuming a loan, that's going to be important. Then there's the occupancy rate as it stands, which is just the inverse of the vacancy rate. So it's the same thing, just inverted. Then there's the average income in the area where the property is located. Then there's the amortization period of the loan, especially important if you're going to be assuming a loan or if you're looking at Fannie Freddie agency debt. Then we have the difference between the market and the in-place rents. You have the population growth where the property is located. So you got some baked in appreciation theoretically in there. Then you have the sponsor record. This is a little bit leaning more towards syndicators in general. The sponsorship record is how many deals are on the go right now, how many deals have already gone full cycle, that sort of thing. Then waterfall, split, and exit strategy, which is what happens to an investor's capital after the original investment has been returned. Do you stay on the deal or do you basically get the boot? And then there's the DSCR, which is the debt service coverage ratio, which means how much of the revenue from rent and amenities is going out the door immediately in the form of paying for the loan. Now, of course, Bernie, you're in the driver's seat, so I'm sure that all of these are important. You have to do a lot of underwriting yourself. But what really stands out? What are the big ones that you look for?
Let me back up just a little bit to your previous segment. The regulations that you're talking about, that is if you get more than one investor into your deal. If you only have one person investing into your property, you avoid all those regulations. So you may have a friend, a relative, or a wealthy investor, and you can get around all those regulations if you just have one investor into your deal. Now, having said all that, with the metrics that I look at actually location first, and then I run the numbers. I look at what my operating expenses are, including the loan, as you have on here. The interest rates, make sure if you're going to buy a property that you make sure that you get a cap rate, which is usually 2% above whatever the current rate is, so you don't get hammered if interest rates move up. Then we're adding in the taxes and insurance and some common utilities that you may have for hallways or parking lot lights, as well as trash pickup, those sort of things. So we're looking at the operating income and the net operating income, on each deal. So in our situation, we try to purchase value property so that we can increase the market price of the property as we, fix them up and raise the rents. So that's basically what we're looking at, some of the basic metrics, but there's more things that we're looking at beyond that.
Perfect. Excellent. I'm just eating up those answers like a delicious subscribe. That looks delicious, doesn't it? It's a very subtle hint that people need to subscribe. But one thing I'm going to do in this episode that's foregoing the normal things you'll see on the dandoesdeals.com chance encounters is normally at this spot, I go through the 6 different roles, which are repositioner, financier, operations, contractor, local, and the KP or deal sponsor, because we already know that Bernie, he prefers JVs like he was describing a moment ago rather than actual syndicated deals like 506B and all that sort of stuff. We'll come back to that in a minute, but if you want to be able to more effectively communicate on the subject of commercial real estate deals, especially syndications, it's a good idea to hit dandoesdeals.com and download your cube right there. Watch one of the other episodes for that piece of the puzzle. But the next question that I have there is, let's really dig into the buy box a little bit more. And when real estate people are asking about somebody's buy box or ideal property, we're basically saying what's easier to say yes to and more difficult to say no to. And what's hidden in there is we're asking about 3 things. The first one is geography. Where is it? Which state, which county, possibly even which neighborhood? It's definitely going to matter. Now, the second one is size, and in multifamily, the way that you define size is generally by the number of apartment units, and they call it unit count for short. Now, the reason why it's relevant is because the type of groups that are eager to be taking over 10 and 15 unit apartment complexes, they're going to be fundamentally different from the ones that are taking over 100, 150, 350 unit apartment complexes. So that size is going to matter. Now, of course, with other types of commercial real estate, it might be square footage, it might be acreage, but that size factor still applies. But the third one is called class. I prefer the term desirability because class actually has 2 different meanings that should be separated out. And those 2 separate meanings are the condition of the property and the area. If you're talking about the condition, we're talking about how old is the facility, how beat up is it, how recently renovated is it, and what sort of luxuries and amenities do they have that make it more appealing to the residents of the property. Whereas the area, there's a few things, because we're talking usually about residential like multifamily. The school districts where the property is located is going to be very important. The crime rate is always important when it comes to the value of real estate and desirability, which is why I like that term so much. But the other one is the common trope that you hear from brokers saying location, 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 because I call it a trope because I think they really mean traffic, traffic, traffic. If a property is in a busy area with lots of people going by every day, it's going to have that higher amount of desirability than a place that's basically crickets all day. But both of those forms of desirability or class, they rate it the same way as in grade school, where you have A plus at the top, and then A minus, and then B plus, and then B, and so on. So Bernie, as far as your buy box, what are you more likely to go for your next acquisition?
Well, the issue for me is to find properties that are in communities between 5 to 30,000. And why did I do that? Because I have less competition in those markets. There tends to be a lower development for new properties, and in the larger cities or even the suburb of those cities, you have a lot of competition. You tend to have a harder time to find deals that are affordable as an investor. And so I go into communities where there is a need for, good rental property, and we'll buy them. Maybe the quality of that complex is maybe a B to B minus, and then we make them, A to A minus type level. And so that gives us an opportunity to purchase property in communities that needs better rental units, but there's not a lot of development. And that has worked extremely well for us. I'll give an example. Last Friday, we just closed, or 2 weeks ago Friday, we closed on a 16-unit complex that I was able to purchase for $732,500. And the rents were below market. And the reason the rents are below market in some of these communities is because they're not managed well. And they have a property manager that is not good, or they try to do it themselves, and they just have a difficult time managing, and they're afraid to raise the rents because they don't want tenants to leave. So we've already gone in, we're starting to improve the property. And we've already had 2 or 3 tenants that seen what we've done just in the past 2 weeks cleaning up the property. And they are really happy. We've already raised rents on 2 of the units, and we've got some that we're rehabbing right now, but that has been my market niche. The cash flow on this thing, once we get it all stabilized, is going to be net monthly about 30%. 30%. Our operating expenses, including all of our bills, is like $9,000 a month, and we'll be around $13,500 to $14,000 a month in cash flow on that thing.
That's
So
beautiful.
that's a good deal. And so people are going to say, wow, where can I find that? You got to go to the communities where there's demand. And our niche is at 5,000 to 30,000 population. And again, you have to look at all the demographics, as you said. But for us, we can find deals there. There are still deals out there. And with the interest rate environment where we're at and the economy where we're at, there's going to be a lot more deals come up in the next 12 to 18 months, because there's going to be some stress taking place by some investors. We purchased property from people that are retired, they're tired of the rental business, or they just can't manage it properly and they're not making money. They're afraid to raise rents. They're not improving their property. They got bad tenants. It's just a long list of things that gives you, as an investor, to looking at these properties for opportunity to get a property at a really good price. And you make your money, as the old saying goes, you make your money when you buy.
I love it. I love it. So the next segment is talking about people. And of course, this is a podcast. It's ultimately about reaching out to people. And usually when people come on the show, it's because they're looking for some type of partner to complement their skill set. At the end of the day, when you're talking to syndicators, people like me, like I'm involved in a debt fund personally, everybody's in the industry of deploying capital. Sometimes it's your own. Sometimes you need to get other people, like in a JV or in a syndication. But we don't want to beleaguer that fact. And traditionally, because of my background in marketing and tech, it's usually the deal sponsors, people like Bernie, who I'm most eager to speak with, because I can make a more disproportionate difference in their business. Whereas when you're first getting started, you need a grunt who can put in 80 to 120 hours a week. And I'm just not at my most effective, my biggest contribution at that kind of point. So Bernie, though, I know that we had some discussions before this chance encounter, so it's not so much of a chance encounter, but you were mentioning that you want to get the word out there, you want to help people understand this industry a whole lot more, but I don't want to put words in your mouth. Who's out there in the audience that you're most eager to speak to?
Well, I want to speak to the person that wants to accumulate wealth, but they have to do it for the right reasons. Why do you want to accumulate wealth? Because you want to send your kids to a better school, you want to send you want to have a better lifestyle, you want to be able to travel, you want to be able to live healthier. And that all takes money. And for people to understand the concept of wealth accumulation, not just real estate only, but for them to understand that, I think is a very important thing. And it's not as difficult as what everybody makes it out to be. The key for you or for your listeners is you got to get a mentor, somebody that can teach you how to accumulate money. And a lot of that is just handling a set of goals that you need to establish and being disciplined about executing that plan and always taking action every day on going forward. There's so many people that do not take action on their plan of wealth accumulation. I seen this guy speak. I cannot remember his name. It's been 12 or 15 years ago. And this gentleman, he had a desire to host a fishing program on cable. And he was just motivated to do this. The only problem was he had never been fishing before. But he had a vision. And this guy, he hammered, and made connections, and he got a program on one of the channels to host a fishing program. And the only problem was he didn't know how to fish. So he had to take a crash course in fishing. He had read all the fishing magazines, he had done all the different things, but the guy was focused on what he wanted to do, and he got it accomplished. And that was one of the best stories I've heard about somebody accomplishing their goals.
Yeah.
So it's a great story, but he took action. He took action to meet what his desire was, and he was successful at it. So that is the same thing that needs to happen with people in your audience. You got to be focused. You have to have a plan. You have to have a perspective on where, and to know where you're going.
I love that. I love that. And so the next question, it's the one about how to reach out. You know, of course, like I have the hat that says dandoesdeals.com. I got a QR code that goes to the Amazon author page with the different books that I have out there on different business related skills, skill building topics. And of course, I'm lucky enough to have this rather distinct last name, which means I'm really easy to find, especially on LinkedIn, where I spend most of my social media time. But Bernie, if people want to reach out to you, what are the best ways to do that?
Well, you can email us at firstfnl, FIRSTFNL at yahoo.com. We are getting ready to launch our own podcast, Strong Financial Life, and that should be going out in about 30 days. We're working on the production of that, but looking forward to do that. And also, I am on LinkedIn.
Excellent, excellent. And that brings me to my my public service announcement. Is not for you, Bernie. It's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs and like migraine-like symptoms, I think it's because of that downright hideous subscribe button that you probably haven't hit yet, and it's free to hit it. All it really does, just full disclosure, it means that if enough people hit it, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. The trade-off to you is that my videos may show up on your list of suggestions. You can feel free to ignore those suggestions because, quite frankly, I just appreciate the fact that you spent this time with me. Just like Bernie, I appreciate you joining me. This has been great.
It's been wonderful. And Dan, I appreciate your friendship, and I appreciate this time to share with your audience.
Awesome. Thanks. Oh, hey there. I hope you enjoyed the show. And if you are into chess, if you play chess and you're an investor of some sort, real estate or otherwise, well, you can be on the show too. I know, right? All you have to do is connect with me on LinkedIn. My name's Dan Friedenberg, so I'm super duper easy to find on LinkedIn, where I spend most of my social media time. But if you're one of those people who just don't play chess, don't pay attention to him. I don't judge. All you have to do is go to dandoesdeals.com and you'll find the Chance Encounter series where you're welcome to be a guest on it, where you can share your core competencies that you're likely to contribute to a GP team or a JV. You don't have to be doing syndications. And we'll talk about your buy boxing and stuff like that. It's easy peasy. It's like 15 minutes long to record, and there are no real fastball questions. Just tell the truth and everybody will be fine. And if that's not really your thing, dandoesdeals.com, it also has the way to meet more, join more people, add more people to your investor list, your different deal sponsor operators and KPs and passive investors, all that kind of stuff. I'm probably repeating myself, but I'll give you the rest of your day. I appreciate you watching Chess with Investors. See you next time. Bye.
Does nothing but put more money in the pot.
Right.
If we talk about just the investor side, I mean, Shane talked about the sponsor side a little bit. I'll talk about the investor side. Okay, so you want the most money in terms of return with the least risk. All right, you want to do it yourself, you can go get 13 or 14%. You're going to do all the underwriting, it's not going to be passive.
If you bet, probably not.
I think I'd have to bet at least $2,500 before they fold.
And the pot is
4,000.
4,000. Yeah, I think you're right, but I'd rather just check.
Okay.
First position, you have the right of collection and the right of foreclosure or sheriff's sale, well, wherever you're at.